All right. Well, I would like to give a huge welcome to Mark Carney. Welcome, Mark, to UNEP Finance Initiative and its 16th biennial Global Roundtable, which this year, for the first time, is in full virtual format. Mark, in your role as the Governor of the Bank of England and previously of Canada, as Chair of the Financial Stability Board, and now as UN Special Envoy and Advisor to the UK Prime Minister, you've probably done more to embed climate considerations within the financial industry than anyone else in the world. So I think it's very timely and appropriate that you can give us your direction today, and then, of course, looking forward to COP26 towards hopefully what we see as a raising ambition, both within the private sector and also through signaling to that of governments. The first question I'd like to put to you is that you've talked about the good progress that's being made in terms of financing renewables and starting to divest from coal, but that you've mentioned that the real challenge is more about the whole economy transition. What exactly are you getting to with this?
Yeah, well, first off, Eric, thank you very much for having me, and let me salute UNEP's efforts and the specific initiatives around principles for responsible banking, Net Zero Asset Owner Alliance, really translating principles into action, and that's what this is about. And I guess to say there's a few ways to put this, but I mean, clearly it's important. The end state is important. Getting to net zero energy, translating energy into electricity and electricity into renewables. So that sort of destination is important, but we're not going to jump overnight to that destination. And so it's the delta as well as the destination, the change as well as the destination. And it's really a whole economy transition that is required. And so that has numerous implications. The green bond market is an important market. The transition bond market, sustainability bonds, those are important. But in the end, even though they're growing rapidly, they are niche products. And the question that we've been looking at, you've been looking at, and we're working for the private finance side of COP, is in mainstream finance, everyday finance, every professional financial transaction. What do you need? What do the professionals need in order to take climate change into account, manage the risks, and very importantly, seize the opportunities around that? And that goes across every sector of the real economy, if I speak as a central banker, the real economy, and it goes across every sector of the financial economy, from a bank to an asset manager, asset owner, pension fund, sovereign wealth fund, insurer, etc. And so what we're trying to do is build, in many respects, on the progress that UNEP FI has made over the years, and make sure that those foundations are in place by COP. So they're not niche, but they're spread across the entirety. And as I say, whether it's on the asset owner side or the banking side, really build best practice across the whole sector.
Well, I mean, this brings me to the question of the TCFD, because you, in your FSB leadership role, you established the task force in climate-related financial disclosures. What's your sense in terms of how uptake is going today? And do you believe we're headed towards the need for mandatory disclosures?
The short answer on the second part of the question is yes. But let me explain that. So really, it was 5 years ago, almost to the day, that the idea for the TCFD came out. It was formally launched under Mike Bloomberg's chairmanship in Paris, as you know. And then within 18 months, they'd reported to G20 leaders on the framework, TCFD framework, and the best companies, leading companies, started to apply them. Now, so we've been through what will be 3 reporting sessions or seasons, 2.5 really reporting seasons, and the latest implementation report of the TCFD is going to come out next month. Now, what I think it will probably show is, well, it's going to show one thing: there's broader uptake across the sector. There's 1,500 companies across 60 countries, actually, who are applying TCFD standards. And it will show pretty good application for many of them on metrics, on governance, on risk management, but less on the key one of the key ones, which is strategic resilience. So in other words, forward-looking, how robust is a company's strategy to the various transition paths we could have? A smooth path to Paris alignment, or a late and abrupt path or a business as usual path with physical risk dominating. So there's more work to be done there. What there is on the demand side of the equation, so the users of this information, is overwhelming demand for it. Various ways to cut the numbers, but you add up all the balance sheet, it's $150 trillion of balance sheet that wants TCFD disclosure from the users of capital. So the message we're giving, and just yesterday I spoke with the coalition of finance ministers as part of IMF World Bank Week, and I made this point, which is, look, the private sector has brought this almost as far as they can on a voluntary basis. There's application by Glasgow. You governments should be putting in place various pathways to make it mandatory. And if you just give me one second, there's a few ways of doing that, and I think we've all been, and those on this virtual event have been around these issues long enough to know that not everybody does it exactly the same way in their own jurisdiction. That's fine as long as there's some commonality. So there's the EU disclosure, non-financial disclosure framework, which they're working through. There's a very important initiative out of the IFRS, which is just launched for consultation, and I'd encourage the membership here and those watching to get engaged in that consultation, because this is about sustainability reporting. They're starting with climate, but this would be effectively a global reporting standard outside of the United States, because that's the one place the IFRS doesn't apply. And there's also national legislation. We've seen it in New Zealand. Securities regulators like the FCA, Comply or Explain. The message is private sector's brought this a long way. Application's pretty good, but it's not perfect. It's not absolutely comprehensive and consistent. And that's why you want to have this pathway to mandatory, so that those who are supplying capital, whether they're banks or asset owners, asset managers, insurers, etc., have the information they need to take climate change into account in, as I said at the outset, in every financial decision if they so choose.
And Mark, do you think when we work with our members in the across the financial industry, forward-looking disclosures means scenario analysis, and one of the questions that comes up is whose scenario, who decides? And you, as a central bank regulator, obviously, setting scenarios is what you do. Do you believe we're at the point where the scenarios should be given to, let's say, banks or even corporates in how they disclose, or there should be still room for different types of scenarios to be put forward?
Well, as a central banker, I'm going to say yes. Yes, you gave me an either or. I'm going to say yes, and let me explain what I mean by that, which is that it's very helpful to have some common reference scenarios, and those. But to be useful, those reference scenarios need to be coherent, and coherence in central bank stress testing speak means that the economic outcomes and the financial outcomes are broadly coherent. So if you have a big recession, and you have an interest rate response that would be consistent with that, you have an impact on interest sensitive assets consistent with that, you have loan losses consistent with that, etc. Now, the other layer of coherence you need in a climate stress test is obviously the climate outcome, the physical climate risks, which the central banks have been taking from the insurers and reinsurers, where the expertise is, but also, very importantly, the transition risk. So what is the pathway? What we were talking about a moment ago, is it smooth and predictable, or is it late and abrupt? So what has been supplied on that front, literally in the last 2 months, has been 3 reference scenarios by the NGFS, which is this group of 70 central banks and supervisors, that does just that. They're coherent and they have various pathways. Now, I think, speaking as a if I were still a supervisor central banker, what I would like is that an institution takes that one of those reference scenarios, and if they choose to adjust it, and they're open source and they're designed to be adjusted, that's great. If they have a view on certain aspects, that's really what you're looking for as the supervisor or the stakeholder, which is, well, what are the experts? What is management's view of these potential climate pathways? And very importantly, are they resilient if their base case view is wrong? So you have to look at a few of them, or it's not wrong so much because they're scenarios. Scenarios are never right or wrong. You never really think the world's going to be exactly like that, but if things don't come to pass. So just to sum up, there are common reference scenarios now. with all respect to the IEA, these are more useful for stress testing purposes because they're coherent across macro and financial variables as well as climate. But one would expect the industry and individual institutions to tailor them to their own view. And then it's that iterative process with the supervisors and other stakeholders to understand how management's thinking about this and managing both the risks and opportunities.
Okay, great. Very, very clear. Let's move to the secondary objective. Now, TCFD is mostly seen today as a risk disclosure framework. Is it going to be enough to get the financial sector behind the net zero objective?
No, I think it's a great way to put the question. It's a foundation. It's necessary in our judgment. But of course, this is as much about opportunity as it is about managing risk. And the opportunities that are created are quite significant. One way to look at opportunities and look at alignment, I think is something that the membership, many of the members of the Net Zero Asset Owner Alliance do, which is to look at so-called portfolio warming approaches. So, in effect, and there are a lot of experts on this meeting, but for those who haven't looked as closely, in effect, you're looking at the transition paths of the assets you own or the companies you own relative to some reference scenario, which is let's say a science-based target reference to transition path. And is the company, and I'm simplifying, is it above or below the line? Or is it above the line and about to get below the line? And therefore, what is its contribution to overall warming if that were representative of global assets? And some leading global insurers, do this and have specific targets that go from kind of 3 degrees or a little more than 3 degrees they are today to get to 1.5 degrees by certain dates. Now, this is a way to flip risk into opportunity. It's a way to accurately represent to your pension holders or broader stakeholders how their money is being invested. It also is a very effective feedback mechanism to policymakers. I mean, one of the points I make to climate policymakers, heads of government basically, is to say, listen, the Japan Pension Fund does this analysis. They have $1.6 trillion of assets. They more or less own a representative sample of the market, and they think it's 3.5 degrees. So obviously the NDCs put forth in Paris. I mean, we all know this, and I know we're going to hear from Johan Rockström a bit later. Obviously, the NDCs are not consistent with the stated objective. It's another feedback thing. If I can just make one more point on this, though, which is that as part of COP, what we're doing is there's a man named David Blood who helps run Generation Asset Management. A number of financial institutions, including members of the Net Zero Asset Owner Alliance, are diligencing kind of best practice and alternative ways of doing these types of calculation. And the first draft of that report will be out by the end of this year. Plenty of time for the industry to get involved and make it better. But not just kind of flip the risk into ultimately to your question, Eric, it's flipping the risk into opportunity, and it's being able to show to your policyholders, your stakeholders, your investors, and broader society how well you are positioned as an asset owner, asset manager, et cetera, for the transition.
Well, fantastic. And yeah, we're very happy. David will be speaking later around the notion of, aiming towards eventually views on a legal framework to essentially take look at fiduciary duties and how an environmental or sustainability objective plays within the duties. And I want to put my next question around that. You know, critics might not see net zero alignment as a financial objective, but rather as an environmental one. And I ask the question, is it the role of financial institutions to set environmental objectives? How do you respond?
Well, society sets its objectives. And what we have in 125 now countries, 126, I guess, with China, is a net zero objective that is the stated objective of the country. In many cases, it's in legislation and consequences follow from that, follow from that policy consequences. So the objective is that. And then the question that gets asked of every company and financial institution is, well, are you aligned with that objective? Now, the answer could be no, I'm not aligned because, and then you have to fill in the blank on why you're not aligned. I'm not aligned because I don't believe the government's going to do what it says, or just, which you can say, take that judgment, or I am waiting for some technological innovation before I become aligned, which then again, those who supply you the capital will make a judgment about your risk management, or the alternative, and what we are seeing pretty much en masse, is a movement to say, yes, I will be aligned with that. Here are my short-term metrics, so you can judge my progress against that. But what this also does in some industries is it exposes um, what I would call sort of technological choke points down the road, where certain things have to happen. So if I'm in a hard to abate sector, as you know, like steel or cement, hydrogen, the economics of hydrogen need to shift. Okay. In a broader capital market, that tells you that if you can help crack that problem, there is a very large market for the product. So uh, I think the important thing is that we get out clearly these transition strategies. And again, I'll bring back the coherence word. The coherence of those strategies, they won't all be coherent. They'll start to expose where the opportunities are. And then finally, to loop back to fiduciary duty, which is the essence of your question. You're going to have a richer discussion with David, I'm sure. What we are seeing is that there is an alignment in many cases between managing these risks, seizing these opportunities, and getting better risk-adjusted returns to shareholders. Um, and there's substantial evidence around that. And I would suggest further that given that the world is moving towards these objectives quite clearly, at a minimum, companies need to disclose whether they're taking that seriously or not. So do they have Paris aligned assumptions in their scenario analysis? Are they working towards, what are the issues around it? And then judgments can be made accordingly.
Great. So it's really largely about signaling and forward guidance, and letting market forces start to act in a transition in the way that governments have agreed, society is aiming towards, and industry and the financial scene need to step up. Let me move on from investors and insurers to banking, because many in the audience today are new signatories to the Principles of Responsible Banking. Today, there's 40% of global banking assets are now signatories. So we believe it's by far the largest sustainability-oriented target-setting framework within the financial system. And many signatories are going to be setting climate targets in the coming year. Can you give some ideas on how ambitious you think they need to be, and which lines of the banking business you expect that they need to be focusing on?
Well, consistent with our earlier discussion, Eric, I think the important thing is to look at it in the round, because it's a transition. It's a whole economy transition. So one of the issues is so not to get caught in necessarily specific divestment of certain areas and then ignoring what's happening in the rest of the economy. So actually having a financed emission, net zero financed emission objective ultimately is important. Of course, that's quite far in the future, and certainly far in the future relative to the maturity of most banking assets, which is why you need to work backwards and have some interim objectives and targets that are disclosed. A governance process that's clear in terms of specific board level governance and responsibility around managing climate risks and opportunities. Ideally, some compensation linked to that as well, or at least disclosure about whether it is there or not. So I think having the broader scope 3 or financed emission type approach is important, not specific business lines, but across the entire institution, and giving a pathway to that. And let me just link it back to quickly a earlier discussion we had, which is around stress testing. In effect, that's what the central banks will do with the banks, which is to say, okay, let's freeze your balance sheet today. Let's imagine if you had that lending portfolio in 2030, 2040, 2050 on a pathway to net zero, how would it look? In other words, which of the companies you're lending to have a strategy for net zero and therefore are still resilient in 2030, 40, and 50? And if they don't, or if you don't know, what provisions would you have to take for them today? And have you really thought through your strategy? Is your strategy resilient or robust for the transition that, as we were saying a moment ago, that society is demanding? And that focuses it much more into a strategic sense of where the bank is going.
Strategic sense. I think that's a great way to end off. Mark Carney, thank you so much for your insights and your leadership on where the finance industry needs to head in a strategic sense in navigating the climate transition. Best wishes for a successful COP26, for which UNEP FI and its members are committed to supporting towards a successful, ambitious outcome.
Well, we won't be able to do it without UNEP FI and its membership. So we appreciate your support, and we're listening to your priorities. Thanks.
Thank you very much.